I don't really want to see it be a massive surge to the upside because I don't think that's healthy for long-term stability of gold. But I do think, again, this would be the first factor of triggering the next, or at least basing of gold in the near term. I still think I want to be clear that 3,500 is not totally off the table. That's kind of the low end of my target for gold. But I do think we've gotten now to 3,900 in the 39s, and that gives us close enough. That's kind of like close enough, as they say, for government work. If it goes to 3,500, I plan to be a major long-term buyer.
I think we've reached the end game. Fed's got to tighten because inflation's too high. This is the main reason inflation's too high. And that's why I want to point out in this chart in terms of gold's right in the middle here. So putting some numbers on it, gold's back down to $4,000 an ounce. It's stuck there. It's kind of key level. I think it's going to do what it has done in history. Number one is gold is the most expensive versus a basket of U.S. Treasuries since about 1982, 83. So it's 40 years. So it's very expensive versus Treasuries, 5% yields. And so I think it's more likely to head towards 3,000, which is where its long-term moving average is a good support and everything, than sustain above 5,000.
Global financial markets are nearing a massive structural turning point as central bank interest rate policies collide with technical chart setups. Navigating these turbulent market conditions requires examining both long-term macro trends and key support levels. Gareth Soloway, a premier technical chartist, and Mike McGlone, a veteran commodity strategist, outline critical shifts unfolding across precious metals. Technical cycle metrics project gold surging toward $13,000 between 2029 and 2031, following a breakout from a descending wedge structure. However, near-term consolidation could first pull gold down to $3,500, creating a major long-term buying opportunity. Meanwhile, silver faces significant chart resistance below $64 per ounce. A failure to clear this barrier, coupled with broader economic weakness later this year, risks dragging silver down toward $50. Tracking these exact technical threshold zones will dictate where smart money flows next during this cycle. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you and enjoy the video.
This is so fascinating what's going on with gold because my longer term cycle projections show us another wave of massive buying in gold that's going to push it up to 13,000 or beyond. That target again is 2029 to 2031. So it's still a little ways away, but it will come fast. And one of the things we're watching very closely is this wedge pattern on gold right now. And we can see it's pounding on the upper side of that over and over again. And so really what I'm looking at is, do we get a breakout in gold here from this longer term downsloping or descending wedge? If that happens, that should begin the next bull move in gold. Now, it may not be super fast. I think we have to be kind of cognizant of this. I don't really want to see it be a massive surge to the upside because I don't think that's healthy for long-term stability of gold. But I do think, again, this would be the first factor of triggering the next, or at least basing of gold in the near term. I still think I want to be clear that 3,500 is not totally off the table. That's kind of the low end of my target for gold. But I do think we've gotten now to 3,900 in the 39s, and that gives us close enough. That's kind of like close enough, as they say, for government work. If it goes to 3,500, I plan to be a major long-term buyer. But the bigger story here is what's going on in the fiat currency markets. The debt continues to spiral for most countries, including the U.S., and that is just a long-term tailwind for gold's price. Now, the issue with silver on the chart is that we're still hovering below the key level of resistance. And so what I want to see here is really silver push back above $64 an ounce. If it can do that, then I think then you start to look at that bigger bull run coming back in. Until then, I'm still slightly skeptical. I'm a little concerned that if the U.S. economy and global economy does weaken later this year, then silver still could see a little bit of a headwind and pressure down to the $50 level. But right now, again, I would remain more bullish on gold than on silver. Silver, again, concerns me based on the technical chart.
Yep. Inflation is above their target, although it started to come down. Warsh came out swinging hard in his first press conference, pointing out that price stability is the key function, key focus. And to me, that's the bottom line, is that diligence. But now we're at the point where market, I think, just swung too far to rate hikes, because my view is the number one way for Warsh to get what he wants, and that is just a little bit of easing of inflation pressure, which would help his president get elected, is for the stock market to go down. If he eases rates, that creates more inflation. It makes bond yields go up, actually, which has been the trend, and makes the stock market go up, which means more inflation. Rich people make more money, and the average person in this country who's, throwing the Republicans under the mat in the polls to be hurt further. And if he hikes rates, that might be good for a long end, but it's bad for the economy, and that would be, a major profile encouraged, basically, versus Mr. Trump, which is very unlikely. So he's stuck. And to me, the next move for the Fed will be to ease when the stock market goes down and or when it does it for them. The end of July, we're getting towards what's typically volatility season in broad markets. And volatility has actually been picking up almost all year. If you look at 30, 60, 90, 180-day volatility in like the S&P 500. Yes, the market's going higher, but now we're seeing the wobbling, the breaking. And we haven't even started what's typically a normal volatility period in a midterm election. So to me, earnings are insignificant in the macro, because we're at the kind of stage now, similar to the president trying to get the Fed to ease and then realizing, well, inflation's so high and stock market's so high, that means inflation goes higher, and I'm unlikely to get elected, which is in the past we wanted them ease to help the economy, to help you get elected. So that's switched. And now we're at the point that I think we have so much, earnings have been so high. I mean, we're running almost 25% on the year in the S&P 500. That's awesome, but it's almost unprecedented. But part of that is just fuel filling the fire, and it's very scary to me. Now, I've been not so favorable stock market forever, but we have some major signals telling us you really should be worrying. For instance, the pump then dump trend that's happened in metals, gold, silver, platinum, palladium, and iron ore. We're all up in the year, or in the year. Now, obviously, you can tell I'm a commodity guy. Now they're down in the year, particularly gold. Bitcoin was up in the beginning of January. Now it's down 30%. Stuff that's been leading, stuff that was part of that narrative that, the currency debasement, current countries are going to print more money, they're going to pump the system, are all failing. That was last year's trade. And there's only one thing left there holding everything up, is that stock market. So obviously we can dig into crude oil's effect on that. But overall, the macro for this market is people should be underweight risk assets, focusing on just hanging out in treasuries, particularly as we enter the high volatility time of year. Now, that's been my theme all year, and so far it's somewhat been working. Haven't been part of the major pumps in equities, but I just view the key problem I see for all markets is just 5% long bond. Right now, as we speak, 513. It's just too high for gold to go up. For any asset that does not have earnings and does not have income, which is almost all commodities, all precious metals, and cryptos, it's just too much of a headwind, even potentially for a stock market. Risk-free returns at 5%. I just look at it, you're supposed to be overweight treasuries and just wait for it to work out, because we've reached an end game in appreciating risk assets. The number one force for inflation, which is the number one issue in elections, is inflation. Is the U.S. stock market running the highest versus GDP in 100 years? That keeps going up. More inflation means incumbents don't get elected. That goes down, it means deflation, way overdue. It means, everybody loses a little money, except for bondholders. So to me, that's the macro big picture. It's July. And then there's so many little nuances behind the scene that I let people like you who dig in the weeds deeper, and I do. A lot of my fellow strategists who cover energy and metals, and they dig in the weeds. I look in the macro, and the macro is things like what gold is telling us and what silver are telling us by pumping then dumping. Is you're supposed to heed that warning. So overall, Fed kind of is out of the picture. They're insignificant. They can't really do anything. They won't. What's the next catalyst? Crude oil has been rocking things up a little bit. But if you look at the price of crude oil on the screen right now, it's $84 a barrel in the U.S. Meh. That was first traded in 2007. That's 20 years of nothingness, just trading in a range, in a bell curve. And over that same period of time, the stock market's up almost 10 times. That's a deflating asset. I think we've reached the end game. Fed's got to tighten because inflation's too high. This is the main reason inflation's too high. And that's why I want to point out in this chart in terms of gold's right in the middle here. So putting some numbers on it. Gold's back down to $4,000 an ounce. It's stuck there. It's kind of key level. I think it's going to do what it has done in history. Number one is gold is the most expensive versus a basket of U.S. treasuries since about 1982, 83. So it's 40 years. So it's very expensive versus treasuries, 5% yields. And so I think it's more likely to head towards 3,000, which is where its long-term moving average is a good support and everything, than sustain above 5,000. But either way, it looks like the main rally in gold is done. This is what we got here. This was led by gold, this little pump here, which just brought it back to the same level versus the S&P 500 in like 10 years. Now it's starting to roll over again. This is all metals, but led by gold. So there we have it. And the problem is, I'll end with some key facts. 60-day correlation between gold and S&P 500, about 0.7, is the highest in the history of gold with the stock market going up. Now it's starting to go down. You never have one correlations go to 1-to-1 like that in the stock market going up. It's usually when the stock market going down. That might be a warning. And if you look at the annual volatility of gold, right now, gold trades about 2.2 times the annual volatility of S&P 500. That's the highest in about 20 years, since 2007. It's a complete historic oxymoron for what's called a store of value. Stores of value do not trade at higher volatility than the stock market. So see the problem? Gold to me is done as far as the rally. It could trade in a range between 3,000 and 5,000 for a long time.
High U.S. Treasury yields near 5% continue to impose severe headwinds on non-yielding assets, elevating the likelihood of gold retracing toward its $3,000 long-term moving average rather than sustaining levels above $5,000. Industrial commodities reveal similar vulnerability. Managed money net positions in copper account for 27% of open interest, creating a heavily crowded trade where triggering downside stop losses could swiftly drive copper prices back down toward $5. Furthermore, the S&P 500 trading at extreme historical market cap to GDP ratios signals an impending macroequity top. As broad stock market volatility escalates into late-year trading cycles, central banks will remain constrained until equity sell-offs force monetary easing. Holding overweight positions in high-yielding government treasuries offers essential capital protection while stock indices and commodity markets undergo inevitable valuation resets. Now, let's get back to the interview.
So, interestingly enough, I've been watching the dollar yen, and I did expect intervention. I did not expect this level of intervention. And I think that's the big story here, is that it was such a great coordinated effort in utilizing both countries to get involved here that it actually it's almost like in poker, if you turn your hand around and you show your cards to your opponent, it tells me so much more about the concerns that are in the wings here of the government and global governments, that they feel the need to get involved to this level and even start playing around with other currencies, getting in the mix. And again, this coordination, we will likely see it more and more as the debt levels rise of these countries. And I think that is a major story that is probably extremely bullish for gold and silver longer term, but also obviously, if you're a believer in Bitcoin, for Bitcoin as well.
What's happening in copper. When I think of yields, copper typically goes up with yields in the stock market and typically goes down with yields in the stock market. But what I show you here is just the per pound price of copper. It's on the same. I have it on the same similar scale as the S&P 500. You just divide by 1,000 and get the S&P 500. Copper's way lagging. But what's happening is deflation in China. The 10-year note yield in China, I've been pointing out for too long, is 1.73%. That's making a lot more sense now in terms of crude oil not going up. Because what we learned this year was there's severe contractionary, deflationary forces in China that we didn't really realize because it's a closed economy until we saw this pump in crude oil. And actually, it dumped. Demand from China declined exponentially, partly because they filled up the reserves and they just don't need it as much anymore. They're switching to EVs. So this is the key yield I think that matters. Is I think this is where we're going to start heading towards by the end of the year in the U.S. And that's why when you say yields, I think copper is the one that matters. What I point out about copper, what's really significant is sometimes you have to look at really what are positions and what's the mantras. I'm saying that because, like I mentioned, that bond yield at 5% is too much pressure for precious metals, but everybody gets the narrative in the mantra. You can type in any AI bot and plug in what the bullish factors for things like copper is, and that is global demand, electrification, all the stuff we pointed out 5 years ago. And everybody says you're supposed to be long copper. Then you look at things like this. This is the key thing I need to point out. I need to look ahead and through the market. What are positions? Managed money net positions in copper are 27% of open interest in the CME. They fully expect the price to go higher. I fully expect we're going to hit a few stops in that, bring the price of copper back towards 5, and then maybe you're supposed to buy it. But these people are just waiting to get stopped out. And the number one force to get them stopped out a little bit, and the number one force for yields to go down or up is the stock market. And that's what I show you right near the top. The S&P 500 looks like it's potentially topping. Looks like the Kospi top. Looks like the NASDAQ is topping. That's only in July. And volatility is still historically very low versus volatility we're seeing this year in precious metals and crude oil. It's just never sustained. And for a midterm election year. So I've been harping on the same thing all year. Now it's time, I think we're getting past that summer doldrums and kicking into what really happens in the end of the year. So I'll end with this. My key theme for this year remains treasuries, overweight treasuries, potentially standing out in the curve with the long bond at 5%. And if it drops by the end of the year with stock market go down, that might be an add to position. If it goes up by the end of the year, I have no clue what to do.
So essentially you're saying once this really rolls over, like everything is going to get sold off, even like copper, commodities.
Oh, sure.
Yeah. So it's
I like copper in the leading indicator status because it's a complete dud versus the stock market. And I show that here. If you take copper versus the S&P 500, it was basically the same price around 2022 and 23. Now S&P 500 is taking off and copper is just lagging. Part of the reason I point out why, because what's happening in China. People are still bullish copper. I'm like, why would you be bullish this asset when you can just have the stock market? It gives you earnings. It's much lower volatility, but it's a great leading indicator. That's my point. Is when copper, if it starts breaking, which I think at some point it will, everything comes with it. So that's why I've kind of narrowed it down. So I also point out in terms of metals, let me just point over some things I just published. I want to get over to gold too, because they're the same trade now, unfortunately. Usually they were, copper was the industrial, gold was the store value. But what I show you here is something that's very disconcerting as a commodity strategist. The metals index, the Bloomberg All Metals Index, led by gold, is the only sector in commodities that made a new high this year. But what's happened to gold? It was up 25% on the year. Now it's down 5%. Silver was up 60%. Now it's down 18%. But what I show you in this chart to me is highly significant. Is if you look at the broad metals index, divide by the S&P 500, it's a complete dud, a bear market. And it's breaking down. And I point out one key reason, only way I think you can get metals to go back up, which includes gold, copper, silver, aluminum, lead, nickel, zinc, as a group. This gold is beta in that space. To me, the only way you can get that market really to start outperforming the stock market, and I show you that here, is the stock market going down. I'm just showing the stock market cap to GDP at 2.5 times. Let's show this up on the screen. S&P to gold ratio, I got it right here. I'm going back to 2001. It had this, got literally to... it looks like gold got a little too expensive. S&P 500 down to like 1.2. Right now the ratio is about 1.8. But the key thing I want to point out is for gold to start going back to 1-to-1 for an S&P 500, basically going to take the S&P 500 to go down now. That's the problem I point out because, like I said, when typically S&P 500 drives that ratio, historically, the higher volatility almost always drives that ratio. And that's where we've switched completely. So we had this little move down. This is great when, gold outperformed. It really kicked in last year, but it ran its course. Now where it goes from here is completely dependent on the S&P 500, I think. And it's just going to be a question of who wins when stocks go down. And that's what I fully expect is stock market will go down and gold will probably go down less, but everything is going to go down when that happens. And it's just a question of when. That's my outlook.
And that's what's going to reduce that ratio.
Yeah, I think that's what it's going to take. So before, what happened was we got this ratio to go down because the gold took off. Gold last year had its best year in a disinflation environment in the history of mankind. This has never happened. And I look at that as that was a warning. It was telling us something. That obviously pumped up a little more this year, and it's put in a peak. To me, that's the kind of stuff you put in highs that last for decades. That's what it did in 1980 and 2011. Same with silver. And now we're at the stage where, okay, what's it going to do next? Fed's got to tighten. Interest rates are too high. It's a rock. It has no earnings. It got too expensive. Like I say, if you look at versus treasuries, it's the most expensive in 40 years. So to me, that's where everything matters. All that matters now is the stock market. Even for mostly metals, I pointed that here with broad metals, all that matters is the stock market. And for even crude oil. If stock market goes down, crude oil will go down. And crude oil going up might make stock market go down. You see that connection? It's also that time of year where you're supposed to be looking out and looking for opportunities to trade volatility. And I think that's just getting started.
Cross-asset market dynamics reveal unprecedented friction as historical correlations reach alarming extremes. A rare 0.7 correlation between gold and equity markets during stock rallies signals abnormal behavior, typically preceding sharp systemic drawdowns rather than prolonged upside. Central banks face a policy trap, unable to slash interest rates without refueling inflation, nor raise rates without damaging economic growth. Compounding these pressures, contractionary deflation in China driven by falling 10-year yields at 1.7%, electric vehicle adoption, and strategic crude oil reserve accumulation is weakening global commodity demand. A synchronized sell-off is predicted to sweep across equities, industrial metals, and precious metals once the stock market completely rolls over. While gold is forecasted to decline less severely than equities during this broad liquidation phase, sustained upside will remain capped until macroeconomic deleveraging concludes. In this environment of elevated market volatility, capital preservation strategies should prioritize long-duration treasury bonds yielding 5% to weather the storm. Monitoring these macro indicators remains crucial as global markets transition into a broader deflationary regime. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.